Price action explained. Swing trading Nasdaq E-mini futures contracts for 100 plus point gains. Welcome back to the channel. My name is Yu, a professional trader with many years of experience under my belt, and I've been navigating the tumultuous waves of the futures markets. I am on a mission to keep you profitable in day trading by exploring critical concepts and strategies. Today's focus is on price action trading, a fundamental aspect of trading the Nasdaq E-mini futures contracts and an essential component of swing trading. Let's trade better together. In today's exciting new episode, we'll delve into the world of swing trading the E-mini Nasdaq futures contract. Our journey will be led by price action trading strategies, which will serve as our guide in the vast financial landscape. Join me as I secure over 100 points trading two of these Nasdaq E-mini futures contracts. As the trade unfolds, I'll provide an in-depth walkthrough of the price action trading strategies I utilize. Learn how you can harness these techniques for effective swing trading with futures contracts on the Nasdaq E-mini S&P futures. Don't miss out on this detailed examination of a real-world price action trading. Before we get started, let's examine this trade. In this trade that I've made over 100 points on the Nasdaq E-mini futures. As the price was in a steady uptrend, I decided to go short, entering at 15,216.50 points. You will notice that upon entering the market, I also immediately placed a stop loss order. It is important to remember that whenever you enter the market, you should always have a stop loss. This limits your risk and ensures that you do not get caught off guard. Getting caught off guard could lead to a massive loss because sometimes the futures markets can be volatile and we have no control over that as day traders. Upon entering the market short two Nasdaq E-mini futures contracts, with proper risk management in place, now it was time to let the price action take control. As a speculator, it was just my turn to watch the market participants ensure that the aggressive sellers would be able to continually push the price down and make sure that my risk was kept. After the price moved down a bit, I was able to move my stop loss to a position where I guaranteed some profits, and now it was really time to just let the market action play out. As I'll get into more details later, speculators or day traders do not have the ability to move the price. Therefore, we have to ride the waves set by the larger market participants. As the price action dictated to me, based on my experience, the market was in a strong downtrend. The aggressive sellers were constantly pushing the price down, and they were running through all the orders placed by the passive buyers. During this downtrend, you would see the price stall for a moment in a slight consolidation, but then it would just continue to be pushed down. The sellers were clearly in control, and these aggressive sellers were on a mission to drive the price down. I shorted the market at 15,216. My risk was about 15,220. That means I had about 10 points of risk on the Nasdaq E-mini futures. Now the price was around 15,138. It was consolidating. At this time, I was unsure if the aggressive buyers would come in and lift the price up, or the aggressive sellers would be able to keep pushing the price down. After a short while, it was clear that the aggressive sellers were still in control and they forcefully pushed the price down. As you gain experience trading the futures markets, you'll learn that sometimes when the buyers and the sellers are in battle, it's best to sit and watch. You should not be fearful as long as you're in a position where your risk is capped and it's just up to the market participants, or I should say, it's up to the larger market participants to do battle, and you're just riding the waves they create. Therefore, as a day trader or a speculator, it's your duty to cap your risk, enter, and let the market participants do the hard work. During this trade, the price entered consolidation a few times. Now, the inexperienced among us would most likely get scared and exit their positions, only to later enter and chase the price. This method of trading is unwise because not only does it increases your chances of making mistakes and having a loss, you will also get lazy and sloppy, forget to enter with proper risk management, or worse yet, you're racking up fees because every time you enter a trade, there are fees to enter the market. Therefore, it's better to take more calculated risks when you decide to enter the market. As the price continues to get pushed down by the aggressive sellers, many times it seems like the price is going to reverse, only for it to fail again. These times are often times when inexperienced traders get tricked into the market. They will try to buy the bottom in hopes of catching the rally all the way to the top, only for the market to reverse, take them out, and then possibly go in the direction they originally anticipated. With more practice and time in the market, you'll better understand when to enter, when to exit, when the market might be ready to stop and change direction versus when it's just a consolidation where the larger players are doing battle before it continues in the same direction or possibly turn around. These are all details that I will go into later in this discussion. Towards the end, it looks like the price is going to just turn around and go straight up before there's one final push, a large push to the bottom, and then the market starts to turn around. How many times have you tried to enter the market, place your stop loss at a place you thought was safe, only for the market to take it out and then turn around? These are the mistakes inexperienced traders make, and these are the mistakes that I would like to try to help you avoid. Let's trade better together. Have you ever heard about naked trading? What do you know about naked trading? Let's go into some detail. Naked trading, it means that you as a trader can identify the current market movement by price action alone, without the use of many technical indicators. Having too many technical indicators on the charts will lead to paralysis by analysis, where you, the trader, will consistently doubt yourself because oftentimes the indicators are giving you contradictory signals. This approach of naked trading is particularly relevant when swing trading the Nasdaq E-mini S&P futures contracts, where understanding pure price action is paramount. There are 6 main components when you're considering naked trading or price action trading. The first one is, of course, the price action. The second, support and resistance levels. The third, trend line and channels. The fourth, chart patterns, candlestick patterns, risk management. With these, you'll be able to become a proficient price action trader and rely less on indicators and learn how to anticipate market movements. Let's delve into price action. Naked trading hinges on analyzing the price action. Traders monitor the sequence of highs and lows, the formation of specific candles, or the patterns that emerge over time. This is based on the belief that price action patterns are likely to repeat themselves, offering opportunities to anticipate future movements. While this is not a guarantee, it offers an insight. and you'll learn to develop your skills in anticipating where the price should move and make better informed trades. Let's talk about support and resistance levels. Again, in naked trading, naked traders also pay close attention to the support and resistance levels. Support is the price level at which demand is strong enough to prevent the price from falling further, whereas resistance is the levels where selling is strong enough to prevent the price from rising further. These levels offers insights into the points at which the price action historically has had difficulty moving beyond, and often signify a place where the price might make a change in direction. Along with support and resistance levels, these help to form what are called trend lines and channels. Again, these trend lines and channels are another method used by price action traders to help see where price might make a change in direction if it has difficulty breaking through, or it might be a position where the price continues going in the current direction. Along with support and resistance, these trend lines and channels offers price action traders another method that they can use to define risk, let them know if the price will continue in one particular direction or this is a place where the price might turn around and go in the opposite direction. There are many chart patterns that develop throughout the trading day or trading session. Chart patterns such as the two-legged pullback, the cup and handle, the head and shoulders, the double top. These are all some basic chart patterns that most traders should understand. Now, while price action traders do not specifically focus on these, it's good to understand what they signify. There's also the candlestick patterns. Specific candlestick patterns such as the doji or engulfing patterns also play a crucial role in naked trading. These patterns are actually a representation of underlying market structures that are developing where the buyers and sellers are doing business at certain levels, and therefore these patterns will emerge. As naked price action traders, we learn to identify what these chart patterns and candlestick patterns signify based on what the underlying price action is doing, and this offers insight into how to make better informed decisions, such as should we exit the position or should we maybe add more size. These are all important aspects of the next section, which is risk management. Naked trading, despite its reliance on pure price action, still necessitates a robust risk management strategy. We should never forget this. This ensures that even when trades do not go as anticipated, our losses can be controlled and limited to a small portion of our risk capital, ensuring that we're able to trade longer and make better informed decisions. Therefore, in sum, naked trading, especially in the context of swing trading, futures such as the Nasdaq E-mini futures contracts, requires a deep understanding of price action, a keen eye for patterns. It is a method that leans heavily on the trader's ability to interpret bear charts, allowing them to react to the market's rhythm and flows, and not some predefined if this then that strategy which will get you destroyed in the futures markets. Understanding price action, a key strategy for swing trading Nasdaq E-mini futures contracts. Price action trading is a method where you learn to interpret and react to the price movements of a security, such as the E-mini Nasdaq futures contract. As price moves, it tells a story. You're essentially learning the language of price, crucial for both day trading and swing trading strategies. It is important to understand that this subjectivity is influenced by market context. You must learn to understand the current context of the Nasdaq E-mini futures markets. Remember, Price action trading involves a degree of subjectivity or discretionary trading, and different traders may interpret the same price patterns differently, especially when swing trading. It requires a lot of practice and understanding of market psychology. Like any trading strategy, it doesn't guarantee profits and it involves risks. Always use risk management strategies to protect your capital. Time is not uniformly important in the futures markets, since a strong uptrend or downtrend could be a better trading environment for a certain type of traders, whereas another trader will thrive in consolidation where the market is in a tight trading range. Price action can help you, but there is no one universal trading strategy that will work for every trader. Since all traders are unique and have different personalities, risk tolerances, investment risk capital, etc. Indeed, the importance of time in trading can depend greatly on a trader's personal strategy and style. Some traders thrive in volatile markets, utilizing price action to their advantage when trading futures contracts like the Nasdaq E-mini, while others prefer more stable, range-bound conditions. Traders who utilize a trend-following approach may find strong uptrends or downtrends to be optimal trading environments for swing trading. By analyzing price action, they can attempt to capitalize on the momentum of the markets. They might hold positions for longer periods of time, riding out the trend until it shows signs of reversing. Conversely, or on the other hand, traders who prefer range-bound trading or consolidation periods may look for opportunities to buy at the support level and sell at the resistance level of the range. These traders, keeping a keen eye on price action, often operate on shorter time frames and might make many trades within a single day, profiting from the smaller fluctuations in price on the Nasdaq E-mini. In either case, the concept of time remains an integral part of the trading strategy, even though it may be applied in different ways. Trend traders pay close attention to the duration and strength of a trend over time, while range-bound traders may focus more on frequency and regularity of price action fluctuations within a certain time frame. Ultimately, successful trading is less about the objective importance of factors like time and more about the trader's ability to understand and adapt to the market conditions that best suits their individual trading strategy. The most important factor here is for a trader to understand their own personal style, their risk tolerance, and how they prefer to trade. These factors help influence us, but this still requires a deep comprehension of price action and its implications for market movements and potential profits in instruments like the E-mini Nasdaq futures contracts. In the futures markets like the Nasdaq E-minis, there is a buyer for every seller and there is a seller for every buyer. This is an important concept to understand. Every trade on any futures markets, there's always a buyer and there's always a seller. Now, every trade in the Nasdaq E-mini futures market is a dance of price action between a buyer and a seller. Again, for every buyer, there is a seller, and for every seller, there is inevitably a buyer. Once a trader enters the market, if they enter as a buyer, they will have to become a seller to exit the market. And if they enter as a seller, they will need to become a buyer to exit the market. So there's always a seller for every buyer. This interplay affects the markets, and that's why the markets are always shifting. The market is never static, it is always dynamic. The futures market operates as a venue where these participants meet to negotiate contracts, with each futures contract involving a buyer and a seller. Price action comes into play when a transaction occurs as a result of a buyer and seller agreeing on a price for a particular E-mini futures contract. However, as day traders, we must keep in mind that the term buyer and seller here can encompass more than just individual investors. These terms can also represent financial institutions, hedge funds, commodities traders, and even automated trading systems, all of which are continually analyzing price action to inform their decisions, be it day trading or swing trading or even trading for a much longer term. They could be investing for 20, 30, 40 years or something like that. These entities can act as a buyer in one context and a seller in another context. And since they have a much longer time horizon than you do, their effect on the market is much larger, and we should be aware of them. These entities rely on very sophisticated futures trading strategies, and their impact on the market can be much larger than ours. That means we must be aware of them and trade accordingly. Furthermore, although each Nasdaq E-mini futures contract involves a buyer and a seller, not every potential buyer or seller will necessarily find a counterpart willing to agree on a particular price dictated by the current price action and complete the transaction. Sometimes a seller might want to offload a contract, but there might not be a willing buyer at the price the seller wants, or vice versa. This lack of matching can lead to changes in price action of the Nasdaq E-mini futures contract. While it is accurate to say that every completed futures transaction includes both a buyer and a seller, it does not mean that every intention to buy or sell a futures contract will result in a successful transaction. The interplay of supply and demand in the futures market, influenced by a variety of factors, ultimately determines the price action and the price at which transactions take place, shaping both day and swing trading strategies. There's a common misconception among traders about what causes the markets, such as the Nasdaq E-mini futures contract prices, or indeed the price action, to move. It is essential to understand that there are two types of orders in the market: aggressive orders and passive orders, each of which can be placed by either buyers or sellers. This means you could have aggressive buyers or passive buyers, or you could have aggressive sellers or passive sellers. Now, aggressive buyers will enter the market using a market order. A passive buyer will enter the market using a limit order. And on the other hand, an aggressive seller will enter the market using a market sell order, and a passive seller will enter the market using a limit sell order. These different order types affect the way the price moves in the markets. Aggressive buyers and aggressive sellers are those who are willing to trade at any available price. They just want to get in right now and they don't care what price. These are the buyers or sellers that drive the price action by actively pursuing trades. They show a sense of urgency in their acquiring or offloading futures contracts. This can be particularly pertinent in swing trading, where traders seek to profit from huge price swings over a period of time. These market participants typically place market orders which are executed immediately at the best available price. On the other hand, there are passive buyers and passive sellers. These market participants have a specific price in mind and will let their orders rest on the order book until an aggressive market participant agrees to pay or accept their price. These are typically limit orders, where the buyers or sellers set a specific price at which they are willing to trade. In terms of price action, these passive buyers or sellers, their orders will not immediately affect the market. They will rest on the order book until an aggressive buyer or an aggressive seller decides to move the price, in which case their limit orders are then moved by the aggressive market participants. Imagine the Nasdaq E-mini futures markets. On a busy trading day, Trader A is an aggressive buyer. He's seen some strong positive economic indicators and think that the tech sector, which heavily influences the Nasdaq, will surge today. He doesn't want to miss out on potential profits, so he places a market order to buy contracts immediately, regardless of the price. This urgent buying can drive the price up as he snaps up whatever contracts are available. On the other side, we have Trader B, a passive seller of the same Nasdaq E-mini futures contracts. She believes the fair value of the contract is at 14,000 points, and she's not willing to sell her contracts for anything less. So, she sets a limit order to only sell when the price reaches her target of 14,000. While her order might not make an immediate dent in the contract's price, it adds to the number of contracts available at the 14,000 point mark. This can act as a potential resistance level for the contract's price. As the day progresses, more and more aggressive buyers, like Trader A, enters the market, the price of the Nasdaq E-mini futures might climb. But when it approaches 14,000 point level, it may find resistance due to limit orders like Trader B's. Only after all those passive sell orders are fulfilled might the price have a chance to move beyond that level. Understanding the interplay between these different types of orders and market participants is vital for comprehending the price action in the Nasdaq E-mini futures markets. Both aggressive and passive orders influences the market dynamics, either causing the price movements or creating potential barriers to such movements. It is the equilibrium or the disequilibrium between these orders that often leads to price changes, which are a key moment for both day traders and swing traders to execute their strategies. Nasdaq E-mini futures, the three key elements of price action trading. In the realm of the Nasdaq E-mini futures contracts trading, aggressive market participants centrally play a pivotal role in shaping price movements. However, the strategies that they employ, whether it's swing trading or otherwise, these large institutions dictate the market's overall direction. On the other hand, day traders, even when engaging in swing trading, may not exert as much influence on the market as their larger counterparts. It's important to remember this, that as a day trader, we do not control the price action. We are riding on the waves caused by these larger financial institutions. Their impact varies greatly based on how frequent they're transacting, the volumes at which they're transacting, and the complexities of their strategies that they're implementing at the current time. These all affect the overall direction of the market more so than any day trader will. Now that we have an understanding of who and what moves the market, now we could delve into price action. The fundamental aspect of price action trading is understanding who is moving the market, not necessarily why the market's moving, because that's unknown to us. Price action, the fundamental aspect of trading, is always following one of three patterns. It's either going up, the price is either going down, or the price is typically staying flat. When the market's going up, it's an uptrend. When the market's going down, it's a downtrend. And when the market is relatively flat, this is considered consolidation. We're going to go into each of these types of market conditions and go into some more detail. Nasdaq E-mini futures, factors influencing upwards price action movement. What causes upward price action movement in the Nasdaq E-mini futures contract market? An upward shift in price action can be caused when there are more aggressive buyers than passive sellers. In the futures market, the price action is determined by the collective decisions of all market participants, including individual investors, financial institutions, hedge funds, etc. These decision-making processes involves a dynamic interplay of supply and demand for futures contracts. With each change in price action is telling a story of this ongoing struggle. This is particularly significant in swing trading, where traders seek to capitalize on the price movements over a period of time. Upwards price movement in the price action occurs when the demand for contracts from buyers outweighs the supply of contracts from sellers. It's also important to remember that these are aggressive buyers versus passive sellers. More specifically, aggressive buyers are market participants who are willing to pay a premium or a higher price to acquire the Nasdaq E-mini futures contracts immediately, rather than waiting. They place market orders that are executed at the best available price without limit, and their aggression can be observed in the price action. This contrasts with passive sellers who place limit orders specifying a minimum price they are willing to accept to sell their contracts, and are content to wait until the market reaches their specified price. When the price action reflects more aggressive buyers than passive sellers in the Nasdaq E-mini futures market, the higher demand for contracts drives up the price. An aggressive buyer exhausts the available supply at current prices. They must accept higher prices to fill their market orders, which further accelerates the upward momentum of the price action. This effect can be seen more prominently if there's low liquidity, i.e., a shortage of sellers willing to sell at current prices, as each executed order can significantly impact the price action. This is a vital point to consider when swing trading, as identifying these dynamics can help identify potential opportunities for profits or places where risk mitigation strategies can be implemented to reduce risk. E-mini Nasdaq futures, the forces driving downwards price movements. In the Nasdaq E-mini futures contracts market, similar to any other futures market, prices are shaped by a complex interplay of supply and demand, reflected in the price action. When the price action of a futures contract shows a decrease, it is often due to an imbalance where supply exceeds demand. This is a crucial aspect to consider when swing trading, as these movements form the basis for the entry and exit points for our trades. Downward price movements in the price action occurs when the volume of contracts supplied by aggressive sellers outnumbers those demanded by passive buyers. Aggressive sellers are market participants who are eager to sell their Nasdaq E-mini futures contracts immediately, even at a potentially lower price. They place market orders which are executed at the best available price, regardless of how low that may be. This impatience or urgency is often visible in the price action. On the other hand, passive buyers set limit orders, specifying the maximum price they are willing to pay to buy a contract. Their patient approach is reflected in the price action, as they are waiting for the market to come to them, as opposed to aggressive sellers who are actively pushing the market and the price action downwards. When the price action shows more aggressive sellers than passive buyers in the Nasdaq E-mini futures market, the increased supply of contracts combined with the reduced demand causes the price to fall. As these sellers continue to flood the market with contracts, they must accept progressively lower prices to fill their market orders, which drives the market price downwards even further. This trend can be visible in the price action and can be magnified in situations of low liquidity, where there is a shortage of buyers at the current prices. However, it is important to remember that these supply-demand dynamics reflected in a price action are not the only factors affecting price movements. Broader market sentiment, geopolitical events, macroeconomic indicators, and other variables can also significantly influence the price trends in the futures market, particularly in high-volume markets like the Nasdaq E-mini. While the imbalance between aggressive sellers and passive buyers is a fundamental driver of downward price action, it is crucial for traders to consider a broad array of information when analyzing the price action. Speculating on potential market behavior and forming their swing trading strategies. After all, swing trading is all about capturing price movements over a period of time, and this requires a thorough understanding of all the market dynamics. E-mini Nasdaq futures. Is flat price movement or consolidation a sign of indecision? When swing trading the Nasdaq E-mini futures contracts, it is essential to understand periods of consolidation. During these periods, as revealed in the price action, the number of aggressive buyers is roughly equal to the number of aggressive sellers. In other words, there's a balance of power. With neither side gaining the upper hand, the buyers and the sellers are evenly matched in their trading aggressiveness, leading to relatively equal amounts of contracts being bought and sold, which results in a narrowing of the trading range or sideways price action, which most people call consolidation or indecision. This balance, visible in the price action of the Nasdaq E-mini futures contracts, can be disrupted when a new piece of information enters the market, an economic event occurs, or simply the market sentiment has shifted. When one side gains the upper hand and the price action, either buyers become more aggressive or sellers become more aggressive, the price will start to move out of the consolidation range. While consolidation reflected in the price action does indeed represent a state of indecision or tug-of-war between buyers and sellers, it is also a situation when neither the buyers nor the sellers are able to dominate the market direction. It is a period of relative equilibrium or a standoff in the market, observable in the price action until a breakout in either the upwards or downwards direction occurs. In the context of the Nasdaq E-mini futures contract, market consolidation often indicates a point where the larger market participants converge to transact at an agreed upon price. This phase, discernible in the price action, reflects a time when the commitment levels of both aggressive buyers and aggressive sellers harmonizes. This means that there's mutual recognition of value, causing neither party to have pronounced advantage or disadvantage. During this phase, there is a balance with equivalent levels of contracts being exchanged, leading to the market moving in a sideways trajectory or within a confined range. Such a consolidated state, though signaling a kind of stability in the price action of the Nasdaq E-mini futures contracts, can be vulnerable to shifts. For example, consider a situation where a key financial report is due to be released. Market participants might have already positioned their trades based on their anticipations. Once the report is out, and if it contains unexpected data, it can immediately tilt the scales. Those on the wrong side of the prediction might scramble to adjust their positions, and in such moments, the previously observed balance can be disrupted. A surge in buying or an intensification in selling can push the price out of its previous consolidation range. Therefore, market consolidation is not just a reflection of indecision, but more crucially, it denotes a segment where larger market participants find mutual agreement in the asset's value. This alignment in the price action sets the stage until new variables like the aforementioned financial report causes a breakout or breakdown, reshaping the market narrative. Price action during consolidation periods in the Nasdaq E-mini futures contract market can be complex, but they provide useful insights into the balance of power between buyers and sellers, therefore offering potential opportunities for strategic trades when the breakout finally happens. Understanding these periods of consolidation and how they interpret the price action is a critical role for day traders to understand to become successful at swing trading, trading the range, trend following, or many other trading strategies. Nasdaq E-mini futures, a case study of price action movers in the market. In the world of futures trading, a common strategy employed by large financial institutions or sophisticated investors is the practice of what's called iceberg ordering. This type of order could be done in the accumulation or distribution phases and is often conducted by sophisticated investors. How do they achieve this iceberg ordering? Let's talk a little bit about these iceberg orders. They could have significant impact on the price action and often lead new investors to making irrational decisions that end up going against them. It is also important to know that even if you are a range-bound trader or a swing trader, understanding these types of orders can help you reduce your risk and avoid making bad trading decisions. What is an iceberg order? An iceberg order refers to the practice where a large investor, such as some institutional players, hides their full order size and avoids substantial market disruption. This strategy gets the name from the idea that the visible portion of the order is just like the tip of an iceberg, the vast majority of the order hidden below the surface. This process often manifests in the price action as follows. A large institution needs to purchase a considerable number of Nasdaq E-mini futures contracts. If they place their entire order at once, this could considerably affect the market supply and demand balance, causing a significant shift in the price action. To avoid driving up the price and thus spending more, or pushing down the price and getting a worse price for their orders or contracts, the institution instead breaks up the large orders into smaller pieces, placing these orders over an extended period of time. This way, they do not show up to the untrained eye, and these institutional investors could get a fill without negatively affecting the price. By distributing these smaller orders across a day or even several weeks, these institutions' activities become less noticeable in the price action. This strategy prevents significant price spikes that might occur if the full order size were known to the general market. The same strategy applies when the institution needs to sell a large number of futures contracts. It is essential to note that while this strategy might effectively mask large orders, keen market participants might still notice consistent buying or selling pressure in the price action and adjust their strategies accordingly. This makes understanding the concept of iceberging orders a crucial skill for swing traders, as it could influence their trading decisions, allow them to take less risks, or have better trading outcomes. Furthermore, while the iceberg strategy is common and legal, it is vital to differentiate it from market manipulation practices like spoofing, where a trader places an order with no intent of executing them, creating false market signals. These practices are illegal and monitored by market regulators. For day traders, it is important to remember that price action in the Nasdaq E-mini futures contract markets is influenced by various factors, including the broader market sentiment, macroeconomic data, geopolitical events, among others. Thus, for day traders, a comprehensive understanding of these dynamics is key to developing an effective swing trading strategies. Or, if you're a range trader, that will also help you make better decisions and avoid taking unnecessary risks. Volume interpretation in Nasdaq E-mini futures, a price action analysis. When it comes to futures trading, one of the key contracts of interest in the E-mini, which tracks the Nasdaq index. Swing trading. These futures contracts require an in-depth understanding of the price action, as well as the role of different market participants, and the various strategies they employ. Among these, Iceberg order strategy is one that has the potential to greatly influence the volume and price action. We've previously discussed what iceberg orders are and how they are achieved. Let's briefly expand on that a little bit. An iceberg order is a strategy used by large market players to disguise their true intentions. Like an iceberg, only a small portion of their total order is visible, while the bulk remains hidden, hence the name. When these orders are executed, the true volume of trading can be obscured, creating a perception in the price action that the volume is lower than it actually is. This is because the iceberg order is broken into smaller lots that are progressively executed. Understanding the impact of iceberg orders is crucial for swing traders working with the Nasdaq E-mini futures contracts. This perceived volume might indicate lower trading activity, while in reality, a large player might actively be executing an iceberg order. Traders who do not recognize this could misunderstand the volume data, potentially missing vital signals about the market direction. For instance, unusual surges in volume visible in the price action usually signifies strong investor interest and could indicate the beginning of a new trend. However, if this volume surge is the result of an iceberg order, it's primarily the activity of a single player, not a consensus among multiple investors. This could lead traders to draw inaccurate conclusions about market and its likely direction. Incorporating the understanding of iceberg orders into swing trading strategies can help traders more accurately interpret volume data and make better informed trading decisions. It is important to remember, though, that volume is just one aspect of the market dynamics, and successful trading strategies typically incorporate other tools and possibly some indicators as well. Recognizing iceberg orders in price action is a complex skill requiring a sophisticated understanding of the market mechanics and thorough analysis. As with all trading strategies, it is important to consider multiple influences on the market and not to rely solely on a single indicator or set of data. Price action essentials in Nasdaq E-mini futures swing trading. In the context of trading Nasdaq E-mini futures contracts, swing traders must be cognizant of a myriad of factors that influence the price action. Among these, understanding the strategies of large market participants and the things they use, such as iceberg orders, can provide some valuable insights. However, trying to actively detect and trade based on these strategies might not be the most effective use of a day trader's resources for several reasons. These things could be resource intensive. You could also misinterpret the risk. They are unpredictable. Using focus, as well as legal and ethical considerations. Let's talk about the resource intensity. To identify iceberg orders, one would need significant computational power, complex algorithms, and extensive market data. Most individual traders lack these resources. Large institutions usually use advanced software and algorithms to implement these iceberging orders, making it more challenging for individual traders to keep up. Let's talk about risk of misinterpretation, because attempting to spot iceberg orders can lead to false signals and misunderstandings. The hidden nature of these orders mean it is easy to underestimate their full size and their impacts on the market, leading to unexpected price action and potential losses. Therefore, day traders should avoid spending time trying to identify iceberging orders and spend time learning price action and how to speculate market direction more effectively. Let's talk about the unpredictability. Even if an iceberging order is correctly identified, predicting how the market will react to one once the entire order has been executed is another challenge. Market movements are the results of many factors, not just the activities of one large market player. Swing traders typically excel by developing and sticking to a trading plan based on their own strategies and signals. Hunting for hidden iceberg orders can divert attention from this focus, leading to decisions based on speculation rather than sound analysis. Therefore, as day traders, we should focus on our price action trading and not try to figure out what the market is doing or who is doing something in the market. That is irrelevant to us. Another thing to consider is the legal and ethical considerations. There are ethical considerations around trying to identify and trade based on hidden orders or the orders of others. In some jurisdictions, this could potentially fall afoul of the law, and you could possibly spend time in jail. Therefore, you should be careful. Given these factors, swing traders dealing with the Nasdaq E-mini futures contracts or any other instruments would generally be better served concentrating on refining their own trading strategies and understanding the broader market dynamics rather than trying to hunt for iceberging orders. A day trader should be building a robust trading plan, staying disciplined in its execution, and learning about market mechanisms can provide a more reliable path to navigating the market effectively without needing to uncover the hidden strategies of large players or even care who they are or what they're doing. The Nasdaq E-mini futures contracts, swing trading, and price action with naked trading. In the dynamic world of the Nasdaq E-mini futures contracts trading, it is filled with various strategies that traders can employ to navigate the markets effectively. Among these are price action or naked trading, particularly for swing trading, stands out as a powerful approach. Understanding price action trading is a method that focuses on the analysis of the changes in the prices of the securities and can be immensely valuable asset in a trader's toolkit. This method, although not new, is renowned for its potential to enhance trade outcomes significantly when applied effectively. Price action trading, or naked trading, requires a deep comprehension of how market prices move, the ability to identify patterns, and the competence to formulate trades based on these patterns. This knowledge is vital when trading securities like the Nasdaq E-mini futures contracts, which are often subject to rapid price movements. Whether you're drawing trend lines or deciphering the market direction, interpreting candlestick patterns to predict price reversals, or assessing support and resistance levels to understand price limits, every aspect contributes to a successful price action trading strategy. However, acquiring proficiency in price action trading demands time, practice, and patience. The internet is riddled with information on the topic, but sifting through it can be daunting and time-consuming. Therefore, we encourage you to consider our comprehensive resources designed to provide you with in-depth knowledge of price action trading in an organized, accessible manner. Ultimately, whether you're a seasoned swing trader or a beginner in the Nasdaq E-mini futures contracts market, gaining a firm grasp on price action trading can significantly elevate your trading performance and outcomes. Remember, I am on a mission to keep you profitable in day trading by exploring critical concepts and strategies. Today we focus on price action trading, a fundamental aspect of trading the Nasdaq E-mini futures contracts and an essential component of swing trading. Let's trade better together.